Hello and welcome back. Today we'll be taking a look at the GLCC ETF, which is the Horizons Gold Producers Equity Covered Call ETF. Like all the ETFs we cover on this channel, this is an income oriented ETF, and as the name suggests, it mainly holds companies that are involved in mining of gold. Now we will take a look at how this ETF performs, what are its distributions, what is the strategy involved, and I will also go into why this ETF makes sense to hold in the current market conditions. So, without further delay, let's get started. Starting with its holdings, as I said earlier, this ETF only holds companies that are involved in gold mining. And as you scroll through the list, you will see that most of these names are big names in this field, very familiar. Barrick Gold, in fact, is held by Warren Buffett. So these are well established companies and have been in the business for a good number of years. So the holdings look good. If you look at it in terms of geographical diversity, there is not much really. In fact, 60%, almost 60% of the holdings are within Canada. And then we have South Africa, US, and UK. So there is not a lot of diversification in terms of its geographical locations, especially given the fact that there are quite a few good gold mining companies outside of North America as well. I would have liked it to have more diversification in terms of its geographical locations, but that is not really a deal breaker for me. I can live with that. Then, if we look at its distributions, we find that throughout 2023, it has given out a very stable distribution of 22 cents per month, which at its current stock price comes to around 10% per year. If we go back 1 year, in 2022, the distributions weren't exactly as stable. There were a few fluctuations and they were slightly less than what we are getting in 2023. But it is still not bad. It would still come to around 9% per year, uh, based on the numbers that we see on the screen. So, both in terms of distributions as well as its holdings, this does look like a pretty good ETF. But we also know that when it comes to covered call ETFs, an important aspect that must be considered is the strategy used to generate income. Because remember, all covered call ETFs are not using the exact same strategy. Some ETFs write covered calls on 100% of their holdings, some might write it on 25%, some might write it on 50%. So the percentage of the portfolio on which the covered call is written actually has a great impact on the overall return of that ETF, because the remaining portion on which the covered call is not written is actually where we also get a good amount of capital appreciation. So let us check how much of the portfolio uh, in this ETF is used for writing covered calls. And to check that, we can just click on this part called documents, which brings us to these four documents. And if we click on the second one, which says how covered call ETFs can impact your portfolio, it will open a PDF file. And if you scroll down, you will see over here, right in the first paragraph, where it mentions that their options team will sell call options on generally up to 50% of the ETF's portfolio. So this is in general for all the covered call ETFs that Horizons is offering. So this is applicable for the GLCC ETF as well. So 50% of the portfolio they're writing the covered call, and the remaining 50% we have the upside available in case there is any capital appreciation. It's also important to note that the document mentions up to 50%, which means that there might be months where they might write options on less than 50% of the portfolio, which is even better. All right, so now we know that this ETF not only offers a fairly good dividend yield of 10% per year, but in addition, It also has the potential of giving us some capital gains through its stock's price appreciation, because even in the worst case scenario, they are writing the covered call on only 50% of the portfolio. So the remaining 50% is going to appreciate if the underlying holdings go up. However, that does come with a grain of salt, because if you look at its holdings, as I mentioned earlier, they are all companies involved in mining gold. And gold mining companies are not really all that well known for being high growth stocks. If anything, they are just stable companies that pay out a small dividend per year, and you might just hold them if you're really interested in gold. In fact, over the past decade, most of the holdings within this ETF have underperformed the market. And this actually brings us to a very important point mentioned on their website. If you scroll down, you will come across this paragraph where it mentions that effective June 24, the investment objectives of this ETF were changed with the approval from unit holders. But I want you to focus on this second line, which mentions that the stock which we know as GLCC today, in the past it had the ticker symbol HEP, and it was called the Horizons Enhanced Income Gold Producers ETF. So they basically did a complete rebranding of this ETF because the performance of HEP was quite bad if you look at its 10-year track record. So if you go to Google and search for the GLCC stock, it will actually give you the stock chart, but it won't give you the complete stock chart, which includes the performance of HEP as well. So here I have the stock chart for GLCC, and as you can see, the earliest data point we have available for the stock price is June 30th, which is around the same time when they rebranded the ETF. So if you want to go and look for the HEP stock performance, you will need to go to Yahoo Finance, and there, if you search for hep.to, you will get the chart for the same stock, but before it was rebranded. And if you look at its all-time return, it started trading at $93, and it lost almost 75% over a period of what, 10 years. So it started trading on May 1st, 2011, and the last time it traded was on August 1st, 2022, from $93 to $22. So that is a big drop in terms of capital value. I mean, even if they are giving out like 10 to 12% dividend every year throughout that period, the capital erosion that happened during that 10-year period in this ETF was quite bad. So, based on this, can we say that this is a bad investment? Well, not necessarily, because we must remember that past performance is not always an indicator of how a stock or ETF is going to perform in the future. And we must also take into consideration why this ETF performed so badly in the decade from 2011 to 2020. The important thing we must remind ourselves is that the underlying holdings of this ETF are companies that are mining or producing gold, which makes these companies very susceptible to the movement in gold price. In fact, if we look at the history of gold price, we will find that in the period between 2011 and 2020, gold price went down quite drastically. Here we can see that in 2011 it hit a high of $1,900, and then it kept going down throughout the next 5 years until it hit a low of just below $1,100. And then over the next 4 years, up to 2020, it just kept moving sideways. And we see that during the same period, the ETF of HEP, which is now GLCC, also suffered losses. On the flip side, however, we see that 2020 onwards, gold price has been going up. And if you really think about it, this coincides with Fed interest rates. Fed interest rates during the decade from 2011 to 2020 were really low, which made the US dollar stronger against gold. But ever since Fed started hiking the interest rate from 2020 onwards, the gold price has been going up along with it. And I believe that this decade is probably going to be the one where Fed interest rates will continue to be high. Given how the market conditions are, it will be very unlikely for them to reduce the rates anytime soon, at least not for this decade. So, my calculation says that if the Fed interest rates continue to be high, if it will also mean that gold price will continue to be high, which would mean that gold mining companies held within the GLCC ETF will not experience the decline they experienced in the past decade. And for that reason, I feel quite optimistic about this ETF. And that is my review of the GLCC ETF. Overall, it is quite similar to most other covered call ETFs on the market. It focuses on the gold mining sector, has a pretty good yield of over 10%, and even though its track record in the past 10 years was not exactly very good, given the current market dynamics, the future does seem to be quite bright. But that's again just my opinion based on my own research and analysis. I could be wrong. So, as always, do your own research and due diligence before making any investment decisions, whether it's in a stock or an ETF. If you found some value in this video, don't forget to like, share, and subscribe. Also, add some comments if you have some opinions about this ETF. And see you guys in the next one.